Welcome to Market Monday from the investment team and the trust department at the First National Bank. We're going to start things off today like we typically do with a review of what's on deck for the next couple of weeks with economic numbers and the releases. And, look at the implications of what's going on with those relative to the economy, our read on it, and the markets, what's likely to happen as a result of them. So after that, we'll look at the S&P 500, the Treasury curve, and the corporate high-quality credit curve. Now, we start out with real estate market information. Obviously, that's a pretty key part of the economy. We get consumer confidence, which is really key because consumer confidence is going to drive consumer spending. And consumer spending is 2/3 of GDP. It's a very large component. So what happens with the consumer filters into the economic growth or lack thereof situation very quickly. It's an important number. We're watching it carefully, but it is expected to decline. Consumer confidence is souring a bit from what was expected here, at least this 90.2. That's the expectation for the number. So we get information about incomes and spending. And here again, spending, personal spending is expected to show a 0.2% decline from the prior period in July. That's not exactly great. You don't want to see lower spending. Again, this filters into GDP growth. So this is suggesting that the economy may be tapping the brakes a little bit. If we see a consistent decline in this personal spending number, that's something to pay attention for as we think about a potential recession down the line. But again, we're going to get this PCE index, which is the Personal Consumption Expenditure Index, and that actually is a metric that measures inflation that the Federal Reserve likes to use over the other ways of measuring inflation that are pretty prevalent that most investors are using. The core PCE strips out food and energy prices in order to make the number more tractable. In other words, it removes noise from the trend line when you're looking at this to take out food and energy. The problem that we have with that approach is that the consumer has to have food and energy every month. So the consumer is exposed to the headline number, which is higher than the core number. So yes, this gives an overall idea of trend, but this is what consumers are experiencing, the headline number. So what we have here is a Federal Reserve that, may or may not be doing the best thing right now, according to their own traditions. They have stated repeatedly over time that they are targeting a 2% inflation rate. And, for the consumer that's buying food, it's only 3.6%. The target's 2, remember. And if you take out that food and energy, it's only 3.3%. But yet we have a Federal Reserve that has not hiked interest rates to combat the inflation and bring it back down to the target. We also have the Treasury that's out there buying long-term bonds from the market in an attempt to keep yields low and supposedly to reassure the market. But in fact, 10-year bonds experienced a bit of a sell-off right after that. They popped after the Treasury Secretary said they were going to be buying and then promptly went right back down, suggesting that long-term investors see higher rates in the future because they see growing and, strong inflation. And they need to price for that in their purchases of bonds. The long-term bond investor in government bond is only concerned with inflation as the risk. So when yields are rising, that's because long-term investors demand compensation for what they expect to be a higher inflation period. So they got a clear message at Treasury that the market doesn't necessarily believe that this is a good thing or that it's going to work. And the Fed had an uncommon amount of dissent where, in the FOMC at the last meeting where members wanted to hike rates and rates were not hiked. Also, the Fed has decided to communicate less with the market than it has over the past several decades. And as a result of that, markets are left in a bit of a limbo. Again, we're not sure that this is a good thing. We've typically been relatively critical of the Fed here, and they do have a difficult job. They see things that we don't see, but some of the things that we do see suggest that this may not be the right approach. And that higher inflation is likely going to remain in the future, even if we see a decline in economic growth because they haven't gotten out in front of it. We'll get information about durable goods. And when you take out transportation, that's expected to show a slight decline, although be flat overall. We get that personal consumption indicator, we get retail inventories, and we get wholesale inventories. Now, this is important. They're going to show flat. And when you look at the interplay between wholesale and retail inventories, you can get an idea of what major participants in the supply chain think is going to happen. And this is important because retail builds its inventory orders based on forecasted sales, and they're seeing things down to the register level or the invoice level, whereas the wholesaler gets all its orders from the retailers. And so the wholesaler has to stock a certain amount of inventory and has to forecast what the retailers are. And there's a whole supply chain forecasting issue there. But when you look at what's happening, if wholesale inventories are declining and retail inventories are also declining, that shows potentially that consumers are buying more and expected to buy more. You can see retail inventories hit big orders and they're going up because they're in an anticipation of selling more units to the customer, whereas wholesale inventories are also going up. But then you could see the converse, and you could see wholesale inventories continuing to rise while retail inventories are dropping completely out of the water. And that suggests that potentially retailers are turning off the spigot. So, it's nuanced. You have to make an educated guess as to what it really means, but it is informative to make that thought experiment happen. We'll get information on sentiment. And we'll get information on manufacturing, the labor market, construction spending, all of this stuff. Factory orders is really important. That's expected to be flat. More labor market information rounds out the week, especially when we hit the non-farm payrolls report next Friday. And that's expected to show 65,000 jobs created when we lost 23,000 in the prior period. What's not noted here is that we also lost jobs on revision from a couple of the prior periods as well at that last time non-farm payrolls was released. And that suggests that the labor market may be losing a little bit of steam. What are the implications of the labor market losing 23,000 jobs? Probably not impactful, but it is a decided difference from when things were growing at least 150,000 a month or maybe more over the past few years. So we're watching this. That is another thing. The unemployment rate's expected to tick up 0.1% to 4.2. And typically your economists and certainly your economics professor would have taught you that, 5% was considered to be maximum employment in the economy if you had 5% or less unemployment. And if it was less than 5%, you typically had a hot running economy. So these labor market issues don't appear to be a problem yet, but it is worth watching. Now, moving into the S&P 500, this is the 1-year chart where we saw a bit of a sell-off earlier this year. Then we saw a rapid rise. The sell-off correlated well with the initiation of hostilities over in the Persian Gulf because they knew that that's going to stop oil shipping through the Strait of Hormuz, and it did. The market quickly recovered, was reaching all-time highs, based for a while, and as of right now, after running up almost 23%, it's down about 2% over the recent couple of weeks or the recent week. What does all this mean? Well, we've got oil trading very high in the $90 handle. We've got and energy costs are important inputs to corporate earnings. Those are costs. And there are also costs that consumers have to bear when they have to spend it on filling up the gas, because gas is $4 to $5 a gallon or more, depending on your state. That's not money to be spent in discretionary things. That's money that has to be spent, and it comes out of other economic activities. So that is something that is potentially a catalyst for volatility, especially since this war is expected to continue relatively indefinitely, despite what the politicians are saying. Now we look at the timing of the year. September and October are historically the times of the year where major market volatility spells happen. And with the catalyst of high inflation, a slightly weakening labor market, high energy prices, and markets trading with what Helen Greenspan probably would have called quote unquote irrational exuberance back in the 90s if this were the same period. Same same sort of thing. History doesn't repeat itself, but it rhymes, and it's definitely rhyming with that period, with this, artificial intelligence and chip stocks boom. But now we see that the market's starting to look a little more volatile. And this down here is an average true range, and it shows that the range between, which is the distance between the high and the low of every single day, has gone up from an average of 30 points to now it's about 45, 43. And that's a marked increase in volatility and turbulence in the market. September and October being the historical times when things are most likely to get a little wild is on the horizon. So we do expect that there might be some enhanced odds of volatility. But look out over the long term. Let's talk about volatility in the stock market in the short term. Here we have the crisis of 2008. This is a 20-year chart of the S&P. And this was one of the scariest periods in history, certainly in my career. We all thought the financial system as we knew it was ending. But, by and large, we got through it. The markets are trading up at all-time highs again. Zooming back to that period of extreme turbulence, it went down about 53%, the S&P, from peak to the bottom. And that happened over basically a summer and into the following year. Markets declined. But look at this. This is that same average true range. And it spiked. And it started ticking up before the market really got going down in earnest. And so we watch for expanding volatility by looking at the difference between the high and the low every day. When we start to see a churn that, is getting bigger and bigger and bigger, even if the market's not doing much of note, it's trading within a relatively tight band, on the whole, on the closing basis, we want to pay attention to what this is saying, the difference between the highs and the lows. That might indicate that there's some volatility on the horizon. Same thing with this VIX. This is moving up as well. This is option protection, essentially, being measured. So people, large money managers are out there buying protection, essentially puts on the S&P that calculates what the expected volatility is over the next month. And this thing trading at 15.91 suggests that the market is now expecting about a 1% move every single day. Won't get into the mathematics of that, but that's the read. Going to the 10-year, this gold line on the bottom is where we were prior to the invasion of Iran on February 27th. This green line is where we closed on Friday in the yield curve. And as you can see, it's up markedly. 3-year paper up almost a full 100 basis points, 5-year paper the same. And it goes all the way out the curve. Even out 30 years, it's still up, pretty much 0.5%. And that is the inflation expectations being built into, government bond buyers' purchasing decisions. So they're only going to buy the bonds when they think that they're compensated for that risk of the dollar essentially being worth less because of inflation at the time of redemption. So we're watching this. This is a relatively unusual in recent history level of rates. Certainly, the 30-year paper trading well above 5, 5.25% essentially percent, is an area that hasn't really been prevalent since the early aughts. So we're watching. It suggests that bond markets don't believe what's coming out of Treasury and what's coming out of the Fed. And then, in fact, since it continues to rise, the yield on this, that they're expecting inflation to continue to rise until we get something a little bit stronger from the Federal Reserve. But, moving into the corporate curve, which is where most investors are not buying treasuries at the retail level. We have some really good rates now if you're a fixed income investor. 5-year paper is paying about 5%. You get above 6% out past 20 years. And we're actually strategically not using, that portion of the yield curve. We see further inflation down the line, and corporate bonds have two components in their pricing. One is the overall inflation, like the government bond, but there is also a quote unquote default risk premium in there as well, because it is a private company that you're writing debt to, even if it is high quality. And when we see these rates longer out on the curve that are much more exposed to the impact of inflation, and just the randomness of chance in a highly inflationary environment, that means costs are going up And then if finance teams are not executing on their actual cash and treasury operations at the best rates possible, they could go into trouble. If they're not executing well on their supply chain, they could get into trouble. And so there are a lot of opportunities for companies to do badly, or to do very well relatively. But because of that, we're expecting a lot of dispersion in results, and we might see at some point the expectation for credit risk to expand a little bit. That would be called the spread in there, the credit spread. We don't want to be exposed out here. If we expect rates to be higher next year, we prefer to be in a ladder that's shorter term, shorter duration, while we can, have a bond mature and stick it out on the ladder and presumably reinvest at a higher rate. And we can do that more frequently this way. So that's our kind of view on the credit markets. We don't want to be out past 10 years right now, just because that's where, we start to get into higher levels of duration risk that could cause losses on principal in bonds that we're not willing to expose ourselves to. Is it a bad thing? No, because if you're not selling a bond, let's say you own a bond and you're not going to sell it, you're going to get back 100 cents on the dollar. So if you buy the bond near par, you're going to most likely break even on it. You just might be earning less than a market rate. If you buy a bond fund, though, that has long duration, and this is worth consideration, there is something called NAV erosion, which is a real phenomenon. And if you're not aware of it, you should ask your advisor about it. That is where the actual net asset value is recalculated every day, and the mutual fund trades based on that net asset value. So they get marked to the market every single day, and that causes the portfolio to have the NAV go down, and you could potentially see losses realized that way. It's worth discussing with your advisor what the duration risk is in your portfolio, and whether their exposure is in individual bonds, which is likely to mature at par, or if they're exposed to NAV erosion, and potentially whether that's a good thing. And that issue bears on, the issue of tax potentially as well. There are tax strategies that can harvest losses. These are things worth asking your advisor about. And if your advisor isn't talking to you about these things, we'd be happy to. And in general, we're going to hope that this video was useful to you, and close with this. If you're concerned about the economy, concerned about events in the Middle East, you're concerned about rates, the market trading where it is and how it is, feel free to reach out and chat with us. We love to talk about it. Thanks, and have a great day.